Welcome back to the Deep Dive. This is where we take all that research you've sent over and, well, we try to boil it down for you. Today, we're looking at some really focused stuff on the best AI stocks to buy now for November 2025. Our mission isn't just listing names, though. It's about getting under the hood, understanding the strategy, the why behind these picks.
That's exactly it. And the sources you gave us, they paint a picture of what they call a raging bull market. But it's not just random optimism. There's a specific game plan here. It connects historical timing, these seasonal trends, with tracking where the big money, the institutions, are actually placing their bets.
Okay, let's talk about that timing first, because the sources really hammer this point about a bullish tailwind starting, right now in November. Unpack the seasonality for us. Why is November supposedly such a big deal?
Well, it's based on historical data, looking back quite a way. The pattern they found is pretty clear. It's the 6 months from November 1st to April 30th, they tend to perform significantly better than the other half of the year, May through October.
Significantly better. How much better are we talking? Like actual numbers?
Yeah, the numbers are quite telling. For the S&P 500, the average gain in that November to April window is about 6.8%. Now, compare that to May through October, the whole sell in May and go away idea. That period averages only 2.9%.
Wow. Okay, so 6.8 versus 2.9. That's more than double the gain in the winter-spring months compared to summer-fall, historically speaking.
More than double, yeah. And it gets even more interesting if you look at tech. The NASDAQ 100, it averages an 8.8% gain during that same November-April stretch. So this historical trend, it's kind of the backdrop. It's why the source material says now is a key time to get positioned.
Right, okay, so the tide might be rising, historically anyway. But how do you pick which boats to jump into? Relying just on the calendar feels, well, incomplete. This brings us to how they actually select the stocks, right? This following the big money idea.
Exactly. It's meant to be systematic. The goal isn't just to find good companies, but to find elite stocks, as they call them, that are already seeing heavy buying from institutions. They use this thing called the MoneyFlows process. Think of it as a filter, trying to spot where the professional money is consistently going.
Okay, MoneyFlows process. What does that actually mean? What are they tracking? You see the term green flows mentioned. What is that? Is it just high volume?
Good question. It's not just volume. They define these green flows as large concentrated blocks of shares being bought. And crucially, it's happening repeatedly over time at specific price levels. The idea is it signals deliberate, persistent buying from big players, not just scattered retail hype.
Yeah.
They want to see this happening for months.
The repeated, chunky buys over time. That suggests someone with deep pockets has a plan and they're sticking to it. The source also mentioned this MAP score, said it was super strong at 82.8. What does that number tell us?
Yeah, the MAP score is sort of the final check. It pulls together a bunch of things, fundamentals like earnings growth, the stock's technical picture, and, importantly, how healthy those money flows are. And 82.8 is really high. It basically says, look, the company looks good, the chart looks good, and the big institutions are buying it heavily. It reinforces their whole goal, be on the same side as the smart, persistent money.
That makes sense. It's about seeing where the big bets are being placed and, well, maybe riding their coattails a bit. Because if institutions are buying consistently for months, they've probably done their homework, right? They're playing a longer game.
That's the argument. The source says just chasing headlines without seeing that institutional backing is like flying blind. This process is designed to avoid that, focusing only where the big money shows commitment.
Okay, foundation laid. We've got the seasonal tailwind. We've got the method of tracking institutional flows. Let's get into the names. Number one pick for November, according to the source, Seagate Technology, ticker STX. $53 billion company, data storage.
Right, Seagate. Now, you might think hard drives. Isn't that kind of old tech for AI? But here's the connection. Training these massive AI models requires just unbelievable amounts of data, petabytes.
Okay, but why hard drives, the spinning disks specifically? Aren't SSDs, solid-state drives, much faster?
They are faster, yeah, but it's about cost and sheer capacity for archiving. When you're building the massive data lakes needed to train these models, you need enormous storage that doesn't break the bank. HDDs still win on cost per terabyte for that mass storage, and Seagate themselves, on their last earnings call, specifically mentioned strong AI and cloud demand, so they're directly supplying the big cloud companies building this stuff.
And the institutions spotted this. What did the financials and the flows look like?
Seagate guided strong for Q2. Revenue $2.7 billion, EPS $2.75 a share, both ahead of what Wall Street expected. And crucially, the source said STX saw dozens of green flows over the past 6 months, just relentless institutional buying.
And the result? The stock price.
Yeah, this is pretty eye-popping. Shares surged 172% since that first signal apparently appeared.
Whoa, 172%. Okay, but the critical question then is, are these flows predicting the move or just confirming a move that's mostly already happened?
Yeah.
Is it a leading or lagging indicator here?
That's fair. It's always a mix, right? But the argument from the source is that these persistent flows were the fuel driving that 172% climb. And the fact the MAP score is still high suggests the institutions aren't done yet. They're often willing to keep buying even after a run-up if their long-term thesis holds. The flow shows ongoing momentum.
Okay, well put. Let's shift gears to stock number 2. This one moves from storing the data to keeping things cool. Vertiv Holdings, VRT. Bigger company, $73 billion market cap.
Yeah, Vertiv is absolutely critical. If data is the fuel, Vertiv provides the life support system. They do thermal management, cooling, and power systems for data centers. And with AI, especially with all those powerful GPUs, the heat generated is it's off the charts compared to traditional computing.
We hear about power density a lot. Why is cooling suddenly such a bottleneck? Can't they just use more fans?
If only it were that simple. Think about it. A standard server rack might draw, say, 5 or 10 kilowatts. An AI rack packed with GPUs can pull 50, 80, sometimes over 100 kilowatts. All that energy becomes heat. You need specialized cooling, often liquid cooling, or really advanced air systems. Without what Vertiv provides, these incredibly expensive AI data centers just wouldn't work reliably. They need this stuff.
Okay, that really clarifies the necessity angle. What about their numbers? Are institutions seeing this translate to profits?
Looks like it. Their Q3 results were strong. $2.68 billion in revenue, 1.24 EPS, both beating estimates. And their Q4 guidance was also ahead of expectations. Things seem to be accelerating.
And money flows. Similar story to Seagate.
Maybe even stronger, according to the source. They described VRT as being under heavy buy pressure for months. Used the phrase nonstop inflows persist. They even called the pattern a stairway to heaven, just steady, consistent institutional buying pushing the stock up. It shows real belief that this AI build-out is a multi-year trend.
Storage covered, cooling covered. That logically leads to the third piece, power. The final stock is Ormat Technologies, or RA.
Ormat's interesting. It's smaller, about a $7 billion market cap. They're essentially a utility, but focused on cleaner energy, mostly geothermal power. The connection here is twofold. AI needs absolutely massive amounts of electricity, and the big tech companies building these data centers are under pressure to use clean energy.
So ORA hits both needs, quantity and the green quality. What's a specific catalyst getting institutions interested now?
The big buzz is around potential contracts. The source says ORA alluded to multiple hyperscaler power purchase agreements expected in the next few months.
Okay, power purchase agreements, PPAs, unpack that for us. Why is a deal with a hyperscaler like an Amazon or a Google such a big deal for a company like Ormat?
A PPA is basically a long-term contract, often like 15 or 20 years, where the hyperscaler agrees to buy a certain amount of electricity at a set price. For Ormat, landing one of these is huge. It means guaranteed revenue for decades from a very reliable customer. These hyperscalers need massive, reliable power for their data centers, and ORA offering clean power makes them a really attractive partner.
And that potential translates into expected growth down the line.
Exactly. You can see it in the estimates. For 2025, sales are projected around $967 million. But then in 2026, they're expected to jump to $1.11 billion, with net income growing too. It's that anticipated jump, fueled by potential PPA signings, that the source argues the institutional money, the green flows, are betting on right now.
Right, and this is where it all kind of ties together, isn't it? For you listening, notice the pattern here. The institutions aren't just chasing the latest AI software. They're buying the picks and shovels, the underlying infrastructure. Seagate, STX, for storing the massive data. Vertiv, VRT, for the critical cooling, and Ormat, or RA, for the clean power needed to run it all. It's like the whole supply chain.
That's the core insight, yeah. The source argues that the way to play this phase of the AI boom is by following the money into these foundational companies. They believe tracking these elite stocks with heavy institutional backing is key for success into year-end and beyond, as they put it.
So the big takeaway for you. You've got that seasonal context, the November-April string. Remember, 6.8% for it, 2.9% for the S&P. And you've got three concrete examples, STX, VRT, ORA, showing how big money is betting on AI infrastructure. Storage, cooling, power. The narrative seems to be shifting to these physical needs.
Yeah, the underlying message is clear. For AI to keep growing, you got to build the foundation. Storage, cooling, power, these are the must-haves. And institutions seem to be betting that's where the real bottlenecks and maybe the real profits lie in this next phase.
It's definitely a compelling strategy, focusing purely on where that persistent institutional money is flowing. So let's leave you with a final thought, building on that core idea from the sources. It pays to be on the right side of the big money.
We've seen the flows into storage, cooling, power, the direct infrastructure.
But if the big money is always looking for the next bottleneck, the next essential piece, where might they be looking before it even hits these guys? If tracking the money reveals the theme, are there other, maybe more subtle signs? Think about it. Where do companies like Vertiv or Seagate get their critical components? Things like specialized materials, maybe rare earths, advanced semiconductors needed for their products. Could tracking flows there be the next step?
That's a great question. What's further down the supply chain? Definitely something to chew on as you digest all this.
Absolutely. Well, thank you for sharing these sources with us. Keep digging, stay curious, and we'll catch you on the next Deep Dive.